Zero-day options, coiled volatility, and massive market resets. What signals are hidden beneath the headlines as derivatives outweigh stocks? Tim Quast reveals the mathematical code driving record volatility this quarter.
By the way, that's not a bad thing because it's another way to look at the market, and it has been very accurate. So I like this. And I'm not going to pretend I understand everything you say, but I try.
Yeah. Well, you're the host for a reason, and that's because you succeed. But so here's what the data are telling us, and not to self-congratulate, but you and I talked, I think it was April 28th, and I observed, not knowing what would happen, that the probability of volatility could return late Q3 or early Q4. And here we are, early Q4, and we have this sudden surge in volatility. And what does that? How come the market, how come the futures are down 400 points and then the market goes up 400 points? And how come it appears that every time Donald Trump says something, the market moves, and then it doesn't? Is there a rational explanation for all of these things? And I will submit to you, Brian, that there is. And it's not that we all are constantly reacting to news, no offense, and whatever the president says, but it's because the market is mathematical. And most of the time, it's very predictable. I've mentioned the 1, 2, 3 rule before. You could look at the market today. 50 to 60 basis points gains across the board. That's half the market's volatility. This is how the market works. The 1, 2, 3 rule is 1% is SPY. I'm picking them as an example of the benchmark. 2% is how much the basket of underlying stocks will move. 3% is momentum. And that works until the gaps narrow. It's the opposite of the VIX. Everybody wants to look at the VIX, but it's a consequence. If you see SPY, the spread narrow to 50 or 60 basis points, look out. And that is what happened in early October.
Because that is that coiled spring, effectively, I think.
Well, yes, and here's why. Because, people think the stock market is a reflection of rational thought. Well, it's really not. All you have to do, folks, is go look at the Growth Fund of America. Largest actively managed fund. Its number 5 or 6 holding is cash. Why? Because it has redemptions. Look instead at BlackRock. $206 billion of assets gathered in the quarter. They have tens of billions of dollars to deploy. Most of it goes to large caps. Who prices the large caps? Citadel, Susquehanna, and Jane Street. I'm picking on the 3. But the one makes markets in equities, the other 2 in ETFs and options. And so long as the spreads are narrow, that works. When they narrow too much, the economics break down and somebody quits. And then we have volatility and the whole market goes topsy-turvy. And it takes 2 quarters. That's how long it takes
to sweep
up
the.
I don't know why, but it does.
Sweep up the residue. All right, so Tim, you were coming after the media a little bit early. I'm going to come after you in a very nice way, of course. You always like to say you don't like saying the longest stretch for stocks since whatever, but then you also just recently wrote that this is the longest period of a certain measure of market sentiment that you follow since 2018. So when I hear it's the longest stretch in 7 years, you've got my interest. What are you talking about? What does it tell you?
Right. I hate the word since, right? You're like, it's the longest time since. Well, so who cares? Well, so what I shared with you is what we could call the volatility of volatility in SPY. And what happened October 10th is really the 6th largest in the modern data set's history. And if you look at the way that the market behaves, the narrowness of spreads, this is a very long, we have one of the longest stretches where the market was neither hot nor cold. It didn't hit what we call a 6 in demand, nor did it get to a 4 where we hit a market entry. And it's been that way for the longest time since 2018. Now, maybe it means nothing. Of course, 2018 was a bear market year. I don't know what's going to happen, but it certainly, when it happens at options expirations, which is occurring right now, it gets my attention because all of those things have to be reset. And when there is high volatility and a long period where we haven't had a reset, there is a higher probability that we have trouble. And really, Monday could be important. New options.
Why Monday?
Because the whole new series for options that tracks the market will reset. And the options market is larger than the underlying equity market. 0 days to expiration options alone are $1.2 trillion notional value daily. The whole stock market is about $800 or $900 billion daily. So these things matter. And when you have double the volatility all of a sudden in a week, and all those instruments have to be reset, do not be fooled by what happens right now today. Could be the opposite or worse Monday. Wednesday are VIX expirations. I will not breathe till about Thursday or Friday.
Well.